Classic. See, that's what happens. I go away for a few days. I was saying that I hope everyone had a great weekend. I hope you had a safe and happy Cinco de Mayo if you celebrated it. And I was in Southern California over the weekend and woke up to a rain squall and heavy winds and ended up with sunshine that day. So back here to sunny Oregon for a change. It's really clearing up today. I guess the rest of the week is supposed to be nice too. Those of you that know me know that I don't like cold that much these days anymore, but you're gonna have to figure out how to deal with less cold and have more of that wonderful, glorious sun in the sky. But today's topic: buy real estate with a retirement account. And I guess this is one of the topics that helps people do just what I was talking about. So the idea with a retirement account is hopefully to be putting things in there and having it work for you. And traditional IRA money, obviously IRA 401k is pre-tax money growing tax deferred. And Roth money is just tax money that grows tax free. So if you've got one of these accounts, we're going to talk about how to use them for real estate primarily today. And but the big thing is there's no such thing as a dumb question. If you got a question on this stuff, probably not going to hit them during the class today. I have a lot to get through, but please don't hesitate to reach out with any questions you got. If you need real estate continuing education for this class, you can reach out to CMOORE, CMOORE, at IRAadvantage.net, CMOORE at IRAadvantage.net. She can get you some CE for you, hopefully. But we're going to talk about the accounts, sourcing them, why people are doing it, things you've got to look at when you're writing an offer, whether it's a purchase or a sale agreement, and really just sort of how to keep you on the straight and narrow with this stuff. Because if we're talking about retirement accounts, IRAs and 401k plans in the Wall Street context, it's possible for you to obviously screw up with an investment decision, but it's really pretty much impossible for you to commit a prohibited transaction. In the self-directed world, if there's a pitfall to it, it's really just the fact there's really no guardrails for you. You've got a truly self-directed account, a checkbook IRA, or let's say a solo 401k plan, because you've got the power of the pen. You're literally able to make purchases and sales as you choose to do when you want to do that. And you've got to make sure that you're following what is allowed in this process. So it's not complicated. The rules have never changed. It's just a very well kept secret. And when we have economic times like we're in, people have a tendency to reach out and want to do more self-direction for a whole variety of reasons. And I guess one of the other things that really happened since the last crash, if we go back 07, 08, we did a lot of transactions, a lot of accounts, people helping save their maybe taxed money. We'll talk about blending IRA 401k money with personal money, or let's say pre-tax and post-tax funds, using them together in a common transaction. So we haven't had as much of that happen. Obviously, we haven't had as catastrophic a situation. So hopefully we don't. But it's just one of those things where there's a lot of misinformation out there. And if you've been on my classes, I've got a statement I always make: the only dumb questions one you don't ask. So, and I guess along those lines, I've got a good friend, or a Rotarian, that his old statement, if you never ask, the answer is always no too. So keep that in mind. And I would say a lot of times, if we're looking at 1031s especially, and that's our sister company, Equity Advantage, rarely is a question whether you can or can't do something. It's how are you going to get it done. In the IRA 401k world, it's really just taking the time to plan stuff out and making sure you're ready to go do things as you choose to do those things. So don't find the opportunity and behind the eight ball needing to fund the account to go make that investment. Get ready to make the investment to pre-finding it, and you're going to be a lot happier. Everyone working with you is going to be a happier situation, a lot less stressful. So I guess if we look at anybody that dives out there, you've probably heard me use this analogy before. If you dive, the whole plan is you plan the dive and dive the plan. And in this, when we're talking about IRA 401k investments, I really think it's critical that you get yourself set, plan for what you're going to do, get get set up, get the accounts established before you go hunting for stuff, because inevitably you're going to find it before you expected it. And the reality is going to take a couple of weeks, 2 to 4 weeks, to get the account established and ready to go. And you can't just simply, we've got a slide talking about this, just going to hit it up front. If we're talking about a real estate transaction, most purchase sale agreements, PSAs, are assignable, or they have that right of assignment in them. And you think, well, gee, I'll just tie it up personally and sign over the plan later. You can't do that. That's what we would consider a prohibited transaction. You personally took the property off the market for the benefit of the plan. So that triggers what would be considered a prohibited transaction. And that would be the ultimate problem with these self-directed accounts is if you commit a prohibited transaction with a retirement account, with an IRA, for example, all funds in that specific account are treated as distributed as of the first day in the year in which you made that indiscretion. So it's really important that you avoid those things at all costs. 401k plans is a lot less catastrophic. It's only the money involved with the indiscretion that's treated as a distribution. But we'll talk about that a little bit further a little later too. So we like to say you've worked hard for your money. We work hard to keep it yours. My name is David Moore, and my brother and I founded Equity Advantage to handle tax deferred exchanges in 1991. And we put IRA Advantage together about, let's say 15 years later to satisfy our investors' requests, really. And what happened is people just kept coming to us saying, hey, I understand I can do this or that with a retirement account, and how do I do it? And so, we worked on this product and put it into good use, and that's really why we entered this space, is to give our real estate clientele more opportunities to go out and accumulate more real estate. So at the end of the day, we work with a lot of people, a lot of different investments, everything from precious metals into cryptocurrencies. We've done a lot of business startups using funding accounts with what's called a rollover business startup. Actually is a process that allows you to use your retirement account to create a business that you actually work for. So we did gold, silver, palladium mining in that space. We've done car dealerships, real estate investment companies, hotel, motels, all kinds of different things in that area. And the franchise world has sort of gotten the idea, hey, look at that rollover business startup if you're looking at olive branch to the future. But that, once again, sort of a byproduct of getting into this space. We really did it just to take care of our real estate clients, whether they're wanting to buy the real estate, make loans, buy notes. All these things are possible. We're going to talk about how to do it. So thank you for joining us, and away we go. If I can get the slide to change. Got it. All right. So first thing I want to say is this is one of my big pet peeves. All right. Self-directed, it's not a legally defined term. It's just a term that describes an account that allows you to go do what you want to do. It's nothing different than any other account. If you look at it in the most basic context, we're really just moving an account from a company that won't allow you to do what you want to one that does. If we're talking IRAs, it's one trust company to another. If it's a 401k plan, it's well, can we take a look at your plan? Does the plan actually, this is what's surprising to me. A lot of times I'll get involved with somebody with a 401k plan. They'll ask me if I can or can't do something with it. And I said, well, it depends on your plan document. Let me see your plan document. I've literally gotten in arguments with administrators and trustees about what their own plan document says. And it was really interesting. One transaction years ago, our client is a real estate broker. He's a CPA, a retired IRS auditor, and he came to us wanting to make an investment in a tenancy in common apartment complex. And I said, well, let me take a look at your plan. His plan allowed that investment. And this is a situation where, remember, I made the comment about the diving and being ready to do this stuff. What happened is we were sort of up against the 8 ball trying to get this deal closed for him, and so time was of the essence. And if we can use that plan to make it work, everybody it would have been a simple deal. It wouldn't have cost him any money. So I looked at the plan document. The plan document said he could make this investment. and not that specific investment, obviously, but investments in that nature, which was basically into a limited liability company that was going to own the real estate. And so I had this conversation with him. I said, well, listen, you're good with what you've got. Just talk to your administrator and see if they'll make it for you. Normally a plan might not allow it. So then you ask, okay, can we amend the plan to allow it? If we can't amend the plan, can we replace the plan? And that would be the normal course of action. But in this situation, the plan document actually allowed him to do what he wanted to do. So we got on the phone. I'm arguing with the administrator over what it said. And finally, he came around to the point where it said, okay, he acknowledged, yes, that was an investment they could make. And the next problem that came up was, well, okay, now you can make that investment. What are they going to want to see to allow the investment to be made? And so they were going to have all the paperwork submitted to them and then approved. And that process was going to take up to a month to get done. Well, we didn't have time to get that done. And I really put it to him pretty succinctly. I said, look, you can allow the investment, take a look at it, approve it, get it done. It's all in compliance with what your plan says. And he's happy, you're happy, you've got a client, or you're not going to do that. You're going to lose a client. I'm going to gain one. And ultimately, at the end of the day, he ended up switching, and we put a plan together that was going to allow him to get where he needed to go, and he got the deal done. But that was just an example of really understanding what is possible. I just feel like a lot of times if we look at the Wall Street world, they're not contemplating people's desire to go out and do other things. We're not talking about, it's not all or nothing. You're going to move what you want to use. And anybody's going to talk about diversification, giving that safe retirement. And that is just one example of a situation where maybe they didn't contemplate somebody wanting to do stuff. The rules have never changed. Since the mid-70s when retirement accounts were started, all of this stuff's been possible. Any restriction you've got, like I said, if it's an IRA, it's via the custodian and what they're going to allow people to make those investments. If we're looking at the 401k plans, it's just looking at the plan and going down that cascade that I just mentioned. Either if the plan allows it, if it doesn't allow it, can you amend it to allow it? If you can't amend it to allow it, you replace it. But the reality is, if you're a participant in a bigger company, they're not going to change the plan to allow you to make these other investments, nor are they going to. The perception today is that company or the administrator, they're going to have more liability if they're allowing the participants to go out and make these other investments. So they typically are going to stay away from it. If you're, let's say, a real estate broker or somebody that's self-employed without employees, we're going to do a solo 401k plan for you, and they work great. And we'll talk about that product in a little while too. If you're not self-employed or you're retired, then we're going to look at, or maybe you've got a company that's got a bunch of employees in a corporate plan, and you want to self-direct. It might be easier to just go out and, let's say, put a checkbook IRA together, IRA LLC, and we'll talk about what that is in a little while too. So we're really going to look at the transaction, say, okay, where are you today and where you want to be in 2, 5, or 10, just like I say in 1031s, and we're going to try to create the investment vehicle that is going to get you there. Now, what I want to talk to you real quickly about is whether you're talking about equity advantage or IRA advantage, we don't sell investments. We don't sell we don't provide investment advice. We just provide the investment vehicle to get you out of what you want into what you do want. If it's tax money, we're going to do it via 1031. If it's qualified money, we're going to do it via IRAs and 401k plans in combination with LLCs and corporations, or maybe just without either one too. But we're going to take a look at those situations, the source of the funds, what you want to do with it, and we're going to help you get where you want to go, as long as it's all fitting within what the law allows. All right. So on this slide, I mean, really, if it's an IRA, you're just moving from custodian A to custodian B, one that doesn't allow you to make the investment to one that does. And as I said, with the 401k plans, we're just looking at plans. So this slide just says what I just said. I got home at like midnight last night. Sorry about that. I knew I had this slide here, but really, this just sort of summarized what I just said. It's easy to do this stuff. As far as establishing IRAs, it can be done very quickly. It's not a problem. Putting the LLC together takes a little bit more time. 401k plans, it takes just a few days to get the plan together. Typically, if you engage us to do a 401k plan, we're going to provide the plan, the tax ID number for the plan. If you engage us to do a basic self-directed IRA, we're just going to create a custodial account with a trust company that allows you to go make the investments you want to make. If you want a checkbook IRA, IRA LLC, then we're going to do that component also. We're going to provide that operating agreement articles, and by the way, the operating agreement for an IRA LLC is specific to that use. The trust companies are not going to allow a normal operating agreement. It's all specific to IRAs, and it's got to be done correctly. And then if it's not done correctly, we can have a problem there. We're not going to have the problem. The taxpayer is going to have the problem with those things. So it's really critical. You're working with people in this space that do it daily, so they understand what you're doing. They understand what the trust companies are going to want to need, and what's going to allow you to stay in compliance. And you just don't want to have a situation where you're paying somebody to learn on your behalf, because this stuff, there's very little case law out there, and it can get complicated quickly, even though it's very simple, as I said in this slide. And we're going to break it down to 2 basic elements that are going to dictate whether you can or can't do stuff. So why do people look at this stuff? Typically, as I said earlier, recessionary times, we have more demand in this space. But if you look at liquidity, one of the pitfalls people from, let's say, the Wall Street world will jab or poke at self-directed accounts, they talk about the lack of liquidity in real estate. Okay, well, the lack of liquidity is basically what gives you more stability typically. Now, if the sweeps are slower and they can be just as bad, but it's going to be a slower timeline to make things happen. The other things is there's always going to be a flight to quality in recessionary times. So if we go down a ways, we've got tangible assets. But one, they're tired of the roller coaster, the ups and downs. And my wife was dealing, she does a lot of work with our retirement stuff and Wall Street. And she gets so frustrated with people buying and selling on news. They say not to do that, and yet that seems like that's all Wall Street's doing, is buying and selling on news. And what's been really interesting to me over the last 6 months, or actually last, say, year, is with the interest rates increasing and every time we have people talk about rates dropping, if you think back a few months ago, before we went in 2024, they said 5 rate drops, the first 6 months. Well, what have we seen? And now they're talking about none, possibly going up. But every time somebody would sort of talk about it dropping, the market, the real estate market would slow down, because, okay, now I'm going to wait for this thing to happen. And so, it happens real estate too. It's just a slower thing. But Wall Street, you've got that instant trading ability. So things go up and down a lot more. The real estate's going to be a lot slower deal for a variety of reasons. Greater financial control. Why not have that money working where you put it? So whether we're talking about the bank that has the account that you've got your money in, it doesn't have to be across the country in New York with some firm you don't know. It can be in your regional bank. If you like that bank, you can have a solo 401k account there. You can have a checkbook IRA account there. It's where you put it, and it's there. Why not have an account that allows you to buy everything the law allows? Invest in what you know. This is one of those things where there's been lots of talk lately about politicians getting wealthy on insider trading. And if you've been to my classes before, you'll hear me sort of, poke fun, and I do it tongue in cheek, and it's sad, honestly. But Martha Stewart, I mean, is she the biggest problem in insider trading? I doubt it. I mean, if you look at all the people that made a fortune in politics with that information, it's really not okay. And yet, if we're talking about a self-directed account, if you're a mortgage broker, you want to take your retirement account and go out and make loans, you can do that. So I would hope that you've got a skill there that's going to ultimately benefit your retirement account. And that's a great thing. If you're a real estate broker, you want to take your money, go buy real estate, do that. If you know hotels and motels, you want to go out and create a retirement account to own those things, or if you want to even create a business you're working for, all of those things are possible. So invest in what you know. I mean, the reality is it's your money. Use it as you want to use it within the law's, guidelines. It's really a wide open world with respect to what you can invest in. And greater investment flexibility. That once again, just why not have a self-directed account that only allows you to buy funds A, B, C, and D when you can have that same retirement account that allows you to buy everything on Wall Street and everything that's allowed outside Wall Street. So it's just a question of diversification. I will say that one of the big misunderstandings in this space, before I get the next bullet point, is people think when they're self-directing account, they're pulling money out of their retirement account to go do these things. You're not pulling money out of the retirement account to go do it. You're just shifting, as I said earlier, with the IRAs from trust company A to trust company B, or from plan A to plan B. So nothing is coming out of your retirement account to do this stuff. It's just changing the custodian, the trust company, or the plan to allow you to do this stuff. Now, with that said, remember earlier I talked about the cost of a prohibited transaction with an IRA and blowing up that account. I'm going to tell you, when we're talking IRAs, leave your Wall Street stuff with your financial advisor. Keep it there. Only move what you want to use into that retirement account, in the self-directed account, because that way you've isolated the two accounts. The Wall Street stuff, you don't have the ability to blow the thing up, where the self-directed you do. You've segregated the accounts, so it's all safe over there, and you're working the other side. Now with 401k plans, totally different. I would say move all your money into the plan and then reestablish your accounts with your financial advisor in that new plan's name and EIN. And that plan, one plan, is going to take care of all the stuff. It's really interesting to me. I talk to people day in, day out with this stuff, and it's so common for people to have 3, 4, 5 different retirement accounts in different places. And I ask them, why do you have this? Well, because my CPA said to do this, my financial advisor said to do this. I mean, and you're just looking at complexity and cost. Why not have that money consolidated? As I said, with the IRAs, we're going to segregate maybe into 2, and you might have to add into that a Roth account's going to be different than your traditional account too. I mean, so that could happen, or an inherited IRA, beneficiary IRA. So it's possible, even if you simplify, you might have 3 different accounts: traditional IRA, Roth funds, and beneficiary. That's possible. You could have 3, even if you're trying to make things as simple as possible. If we're talking about self-employed people, if you're a real estate broker, I'm going to do a solo 401k plan for you all day long. Shove everything into it. Now, we can't fund that 401k plan with beneficiary funds, inherited IRA, or Roth funds, but those plans are going to allow, after you've established them, you can then roll funds from traditional into Roth inside that plan. So your 401k plan can have traditional and Roth money in it once again. So real investments, not alternative investments. This is one of my big pet peeves too. Why is real estate considered an alternative investment? Why is gold considered an alternative investment? Name an older investment than either one of those things. They don't exist. So why is it the oldest, most time-tested stuff is considered an alternative investment instead of a real investment, is what I would say though. It's just sort of that twist of what it's called, I think sort of makes it sound less real. And the reality is, hard times, tangible assets, oldest, most time-tested things known to mankind. Why not have that ability to put those things in your portfolio? Community-based investing, if you want to invest something local, you can do that. Whether it's a piece of land that you know is going to be path of progress that you think is going to be great, you can buy it. Or you want to do a project with somebody in your community that's going to make a difference there, you can make those investments with your retirement account. So you want to make a difference locally, you can do that. Take advantage of today's opportunity. When you've got a checkbook IRA or solo 401k plan, you can make any investment literally by writing a check or wiring money. It's that simple. It's as easy as you buying it personally. You don't have to go work through somebody else to make that investment. A basic self-directed IRA, you're going to have to submit the investment to the custodian. Upon their review and approval, they will make that investment. And as you recall, about 10 minutes ago, I was talking about that client with the 401k that wanted to make that investment. In that situation, that plan, the way he had it set up, was not a truly self-directed solo 401k plan, because he was still having to work through an administrator and trustee to make investments, and that was a different situation. And that takes that immediacy of investment away. So typically we've got our accounts are going to allow people, they're going to have literally a bank account. If it's an IRA LLC or checkbook IRA, you're going to have a bank account in an LLC's name and tax ID number. The member of that LLC is going to be the trust company for benefit of your IRA, and you are going to be the manager of that limited liability company. So it's a manager managed entity. So you're going to have that account at the bank of your choice. And you, as manager, you're just going to write a check out of that account to make the investment you want. The investment's going to be owned by the LLC. If it's a solo 401k, it works the same way. You're the trustee of the plan. The plan's got a bank account at the bank of your choice in its own EIN, and you as trustee have the power of the pen to make that happen. If you want to add an LLC to it, that's fine. You can do that as well. So you've got real immediacy of investment, and you can take advantage of today's opportunities. Tangible assets, great hedges against inflation. We all hear the ads for gold and silver. Well, real estate's the ultimate tangible asset. You're not betting it's going up to make you money. If it's leverage, you got somebody else buying the thing for you. And you know, at the end of the day, it's going to go up, and it's cash flowing for you regardless. I was taught never to bank on appreciation, but you know, if you buy gold, you're betting it's going up. Buy a stock, you're betting it's going up. The real estate, if it's leveraged, somebody's buying it for you, you got cash flow that's going on with that thing the entire time you own it. Security, you know where your money is. You purchase what you want. You know, real estate, if it's unencumbered, it's not going to go away unless you just don't pay your property taxes, and it's still going to take a while for them to take it away from you. Cryptocurrency we mentioned, and then you know, a new business through that rollover business startup. All those things are possible. So common objections: you go talk to your CPA, you talk to your lawyer, you talk to your financial advisor. He, she, they're going to come back and say quite often, these are things I deal with every single day. Oh, why would you want to go buy real estate with your IRA or 401k when you lose, you know, long-term capital gain taxes on that treatment on that investment? And it's true, but there's nothing you're going to buy with a retirement account that gives you those things. So it's really a pointless statement. Cannot be leveraged. Well, why would you take your retirement account and go buy a leveraged piece of property? Leverage, you get a loan on something. So if you bought something 50% loan to value, that's leverage, right? And with an IRA, well, both ways, IRAs and 401k plans, that statement's wrong. It's just got to be non-recourse debt, meaning that property, that thing stands on its own, and that lender cannot come to you to make themselves whole. All right, that asset has to stand on its own. And you're going to go to somebody, and we've got a slide talking about non-recourse debt later, but you're going to go to somebody like North American Savings Bank that specializes in this stuff, and they're going to make the loan to you. All right. What about RMDs, required minimum distributions? So the lack of liquidity, you know, if you're looking at pulling money out of a retirement account, you don't want to pull money out of a retirement account if you're under 59 and a half, because you're going to pay tax and penalty to get money out of that stuff. You know, if you're pulling money out of a 401k plan, once again, you're at 59 and a half age before you start taking in-service distributions. But you know, if you're looking at doing things there, the RMD is, when you get to 72, you've got to take RMDs, required minimum distributions. And the idea is when you've got that and you've got stocks, you just sell stock, you take the cash out and you're fine. If you're taking, and let's say you bought a piece of property and you exhaust all the funds in that. Let's say you had a roof that had to be replaced, something like that happened, and now you're looking at an empty ledger on that account at year's end, and your CPA is saying, well, gee, you've got to take the RMD now, and then how are you going to do it because there's no money in the account? Well, you can take an in-kind distribution. So for example, if the property is owned by a limited liability company, then you're going to do an assignment of membership interest in that limited liability company as that distribution. So there's a couple benefits to that, which we'll talk about in a little while, but it's not a problem. It actually can be quite an opportunity if it's done correctly and you've got good tax people, which once again, this is one of those things where I really want to stress in your investment life. I just feel like good tax people are probably some of the most important people in your life these days, and just gets more and more that way all the time as the IRS comes up with more and more requirements and rules, and even cities are getting into play. I mean, we've got cities that want to keep their hand in the cookie jar on capital gains taxes because they're hemorrhaging money so much. So really good tax people, I hear the complaint, well, they're expensive. Well, yeah, they are expensive, but you can't look at the actual, that just what they're charging you. You got to look at the actual, what they're doing there and the benefits they're giving you also. I mean, it's not just a situation where you're paying them and you're not getting a benefit there. Hopefully they're going to be saving you a lot more than they're costing you. Lose interest deductions, depreciation. Well, I haven't said this yet today, but I'm going to say it right now. When you've got a retirement account, whatever that retirement account owns, it owns. It's not you. So I always say think of it as Susie down the street. You're not going to pay for her stuff. You're not going to take her money. You're not going to buy her insurance. You're not going to do all that stuff. So when we're looking at interest deductions, depreciation, yeah, I mean, you're not going to get those things. One, it's not yours, but two, there's nothing you're going to buy with those things typically that's going to get those benefits. Now, back to good tax people. So if you've got an unencumbered property in a retirement account with an IRA, then there's not going to be any tax exposure on stuff. If you've got a leveraged investment, and as I said, we've got a page talking about it in a little while, but if you've got a leveraged investment, you're going to have tax exposure with an IRA on income or gain attributable to that loan. So it's 50% loan to value. Even with a Roth IRA, you're going to have tax exposure on half the income and half the gain on sale. And you say, well, David, I've got a Roth IRA. I don't have any tax on anything. Well, it's different when you're looking at this situation. The other time that even a Roth IRA is going to have tax exposure is you're conducting business with that account. So that's called unrelated business taxable income. So an example I give is I had a client that had an apartment complex. It had a laundromat in it. The laundromat was part of the investment. That's fine. He liked the cash flow off the laundromat, so he goes out and buys a laundromat. Well, now he's got a business. That's not it might be an investment for him, but that investment is a business, and therefore it's going to have that unrelated business taxable income and some exposure there. When we're looking at interest deductions, depreciation with a leveraged property, the income or gain attributable leverage is that unrelated business taxable income, and in that context, you might be in a situation where you are going to take some interest deductions, depreciation. So good tax people are critical. So I've been talking a half hour already. We've hardly gotten into this thing. Okay, what do you need to know? Really, two things. The rules have never changed. It's just a very, very well kept secret. What do you want to invest in, and who are you transacting between or the benefit of? That's all we're really concerned about. What do you want to invest in, and who are you transacting between or for the benefit of? Okay. As far as investments are concerned, it's simple. All right. Unless it's been, specifically prohibited, it's therefore allowed. The only things that are prohibited for an IRA to buy are collectibles, life insurance contracts, or stock in a sub-S corporation. So it's really wide open. Any purchase just needs to be for investment purposes. If we're looking at 401k plans, the only thing you cannot buy is collectibles. So wide open for you. Just stay away from those things. And honestly, I rarely have people coming in and wanting to do those. I guess where the collectible piece probably comes in more often than not is maybe with cars and with metals, right? So if you want to go out and diversify into precious metals, you need to be working with a broker that specializes in IRA 401k compliant stuff, because just collectible coins don't qualify. It's got to be a high enough purity to satisfy the IRA or 401k requirements. So that's where the collectibles probably start coming in most. Life insurance, I don't think I've ever had anybody who wants to do that, nor have I had people come in wanting to invest in some, sub-chapter S corporation. So unless it's been specifically prohibited, it's therefore allowed. Two, it's who we're transacting between or for the benefit of. We cannot transact between or for the benefit of a disqualified party. So who's a disqualified party? Your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. Now you can transact along with a disqualified party, you just can't transact between or for the benefit of. Now, David, what do you mean by that? Well, you can't go buy mom a condo to live in with your retirement account. That's a prohibited transaction. She's a disqualified party to you. You couldn't buy a kid a property to live in while they're going to college. Same situation there. You can't loan to or borrow from or sell to, buy from a disqualified party. You cannot be a guarantor on the loan for that retirement account. That's a problem there. So we need to just stay away from those disqualified parties. Now, as I said, it's possible to combine disqualified parties into a common investment. That's fine, but it's just going between. That's where the problem is. The other thing that you may or may not have noticed, I didn't say anything about siblings or aunts, uncles, or cousins. That's because they're not disqualified parties. So if you, for example, found that property you had to have, and you've got to make the offer today, and you don't have a retirement account set up, it's going to take us 2 to 4 weeks probably to get it set up for you. I'm going to say, well, do you have a brother or sister that can go make the offer, tie it up, and then when you've got the account ready, at that point they can do an assignment from them to that retirement account. That would be fine. So that's one of those situations where I think it's really important to understand aunts, uncles, cousins, siblings are all fine. And if you ask me why, I'm going to say, well, some senator probably had somebody that they wanted to have taken care of that way. Why is that way? I don't know. It seems like siblings would be sort of fall in line with the others, but I'm not complaining. So what do we typically see when we have a problem with one of these transactions? Typically it's one of these examples in the middle. Somebody's borrowing, they want to borrow money from their IRA, selling property to it, receiving unreasonable compensation for managing. I would say you don't want to ever have any money between the retirement account and you personally. That's just, it's not okay. The reason I've got unreasonable compensation there is my lawyers. Because sweat equity is not okay. So if you want to go out and buy property and you want to go out and work on it, you can't. You can manage it, but do not go out and get dirty on it. And so if it needs to be painted, you're not painting it, you're not swinging a hammer out there, you're not working on it. And really, sweat equity, you'd think, okay, why would sweat equity not be okay in these things? And because you're increasing the value of the account without corresponding expense. Therefore, you've got more money. We're not in the taxed world where everything you're making you're paying tax on. With a retirement account, if it's a traditional, everything that goes in there just grows until you at some point take a distribution. You pay tax on that money as it comes out at normal income tax rates. And you'd think, well, the more money's in there, the more that Uncle Sam's going to get at the end of the day. They should be happy. Plus, it's giving you stability. But I would say the only rationale I can look at and just rationalize in my mind why they would not want that is because they're foregoing, instead of you paying the plumber to do the work, you're doing it. So the plumber would have to do the work and be compensated and pay the normal income tax today. I think that's probably why they don't like to see that. And they don't want tax privileged money competing unfairly with that tax money. So cannot use your retirement account as security for a loan, and you cannot be a guarantor for that loan for your retirement account. Either way is not okay. Those are both prohibited transactions. Buying property for personal use, like I said. Now, I want to be clear. If you want to, I've lost a bracket on that. If you want to go out and buy a property at the beach to retire into, you can do that. You just can't use that property, nor could any other disqualified party use the property until it's been taken fully as a distribution. So can you buy the retirement account, buy the retirement home? Yes, you can. Can you use it in any way before it's been fully distributed? The answer is no, nor could any other disqualified party. All right. And then we'd look at the bottom that UBIT, and that's typically going to unrelated business income tax or taxable income. That's going to be triggered typically by a leverage on investment, or if the quote unquote investment is business. Flipping properties, for example. You can manage all the contractors, they can go out there and do it, but that's a business. It's not an investment. And if you're using it with tax money, if you're saying, well, gee, I'm going to do it with tax money and use 1031, you can't, okay? Because it's property held for resale, not investment. So if we're looking at 1031 context, I look at something, the Clarkowski court case, 9 points used to determine dealer status. And I use that same court case to look at IRA 401k investments and sort of figure out whether our investor is going to be subject to that UBIT. So what kind of real estate qualifies? Rental houses, apartment buildings, office buildings, retail centers, land, any property to be held for investment. Future retirement home? Yes, as we just said, it is possible. You cannot buy a primary residence. You can't buy a second home. You cannot buy a home for a disqualified party or an office to be used by a disqualified party. So you can't go out and put your law firm, in a building that your retirement account owns, okay? And that's just, once again, personal benefit, and a benefit to a disqualified party constitutes a prohibited transaction. So we've just got to look at those things and sort of say, okay, yes or no. Answer each of these questions. Every time you look at an investment, once again, with self-directed accounts, if there's a pitfall to them, it's that the buck stops with you. So every time you go to make an investment, I'm going to say, okay, who are you transacting between or for the benefit of, and does it qualify? I mean, and unless it's specifically prohibited, it's therefore allowed. So it's really pretty wide open. You think of those two things, and that's going to keep you on the straight and narrow. And as I said, it really, the buck stops with you. How do we do these accounts? Rollovers. So if we're talking about any IRA, can be self-directed. We're talking about 401k plans, other corporate plans. If it's a previous employer plan, we can work with the stuff. Otherwise, you're going to have to be 59.5 to get where you want to go with the stuff. And this just sort of summarizes it. If we're talking to IRAs, if we're wanting to use, let's say, traditional IRA and Roth IRA in a common investment, it's going to require 2 custodial accounts. If we've got a beneficiary IRA involved too, one that's been inherited, that might require another retirement account. So as I said earlier, I like simple. So I'm probably going to, if you come to me and say, David, I want to go do these things, and you tell me I've got a basic, I've got a regular IRA, I've got a SEP IRA, I've got a 401k plan, and you're a real estate broker, I'm going to say, oh, why do you have all of those? Now, if you got a Roth account, that's a different deal. Otherwise, I'm going to say, let's combine all of those accounts into a 401k plan. And then if you want Roth money, you can then, after it's in the plan, you can roll funds into Roth as you choose to do that. Now, you're going to pay tax on any of those funds that are rolled, but that's all going to be fine. So any IRA can be self-directed. 401k plans, we've got to look at as a current employer plan, what your age is, under 59.5, you're stuck with it. Previous employer, we can self-direct those things. So really just sort of look at what you got, what you want to use with it. If we're talking in the IRA context, different types of accounts may require a variety of different custodial accounts. We're going to try to simplify things. I just figure, hey, why not have the money where you can use it and pay less to do it? I mean, why have a whole bunch of accounts scattered around where you're paying a bunch of different people to manage these things? And it's, meanwhile, you've sort of splintered up your retirement account into pieces at different places, so you don't have the full buying power anywhere. And if we're talking IRAs, I am going to say, keep your Wall Street stuff where it is and only move what you want to use in the self-directed into the new accounts, the 401k plans. I'm going to say, move everything into the new plan, reestablish your relationship with your financial advisors in the new plan's name and the EIN, and you're good to go. And that just takes care of it. You don't need multiple plans. You don't need multiple accounts. So how do we make one of these things happen? All right, we're in an electronic world, and trust companies, it doesn't matter where they are, it doesn't matter where you are. If we're looking at retirement accounts, we're looking at an IRA, basic self-directed account. If you go into, there's probably a dozen major trust companies that specialize in this, in self-directed accounts coast to coast, and any of them can take care of you. Now, every custodian has different requirements and different ways they do things. But with a basic self-directed account, you can go online to any of these companies and establish an account online. very inexpensively. I mean, you might be able to do it for $75. I mean, there's nothing to it. And you know, with that said, people still will engage us to put one of these accounts together for them because they just are reassured by us being involved. But you don't need us for a basic account. And really, if you're working with us, you're just going to fill out a 2-page application. You're going to return that to us along with a copy of a photo ID and your current account's most recent statement. And we're going to take a look at different things, what you've got there, obviously, make sure we're creating what is necessary. And that's one of the benefits of working through us on that stuff. But it really, we're going to take that paperwork, we're going to fill it in a variety of forms, and then submit to the custodian, establish that custodial account. And one of the forms that's going to be in that bundle of paperwork is a transfer authorization form. So if we're going IRA to IRA, the new trust company can go to the old trust company and say, give me the money. Now you've got to go to cash in the amount you want to use. If it's not cash and that request comes in, it's going to bounce and it's going to sit there and you're going to be frustrated because the account transfer didn't happen. Now I'll just warn you that it takes some time. You're saying, why does it take a couple of weeks to fund one of these accounts? Well, because people have to move money. The money that they've got is in different investments. You go to cash on that stuff, and then they've got to then honor that request and get that money moved. And sometimes they're not real happy about losing those funds. So just know it's going to take some time to get where it needs to be. And then when it hits the new custodial account, if we're talking a basic account, it's going to be there, for a while before it gets out. You have to talk to each trust company. Is going to have a different policy with respect to, how long they're going to hold it. Make sure good funds are in the account. Now, if you are moving through these things if you've got an investment in hand, as you're establishing the custodial account, or if you're working with us as we're establishing the custodial account, we're going to be looking at paperwork, the investment authorization paperwork, to go out and make the purchase you want to make. So that's another conversation we're going to have a couple pages from now. But so what I'm saying is, if you're all set, queued up, ready to go, the money's going to go from custodian A to custodian B, be there for maybe 48 hours, and then they'll fund the investment if it's all been approved at that point in time. If we're doing what's called a checkbook IRA, we've got another step involved, because it's going to go custodian A to custodian B. Custodian B is going to make the investment in the LLC, which you've got a bank account at the bank of your choice in the LLC's name and EIN. And then after that account sat there for whatever they were going to require, then you're going to be free to go make the investment you want. So once again, it takes some time to make these things happen, but it's a simple deal. And most trust companies have online forms. You fill out online, get the accounts established, or you can engage us to establish those custodial accounts. This is what is called a checkbook IRA or IRA LLC. Now, as I said, we're still going to source the retirement account with whatever source funds it is. And then as that account's been established, or as it's being established, if you're working with us, we're going to be putting that IRA LLC together. So we're going to want to know potential names for the limited liability company. We're going to know where you're buying, what you're investing in, and I shouldn't say 9 times out of 10, but a lot of times, if we're talking John Smith's IRA, they want to say John Smith IRA LLC. I'm going to say, no, don't do that. I'm going to tell you, name the IRA LLC something that is not you. Remember when I talked about Susie down the street? That name should be something that is so unique that every time you look at it, it's not you, and that account's going to be the owner of everything you're doing. So the money's going to go through the custodial account, make the investment in the LLC, funds the bank account, and then you're free to write the check to go do what you want to do. You're the manager of that LLC, and that thing just works great. It really gives you immediacy of investment, allows you to manage properties. Otherwise, you think of basic account. If you look at a property owned by a basic account, the trust company would be the deeded owner of the property. Okay, so who's going to approve each time you've got a tenant that's going in or out? I mean, you've got to have professional management in that context. If we're talking a checkbook IRA, as the manager of the LLC, you can manage that property, you can screen the tenants, so on and so forth. So when we're doing these things, when we're looking at that IRA LLC, we could combine traditional money with Roth money. We could have you and your spouse's money in there. We could have you in there even. So it could be any variety of people funding that investment vehicle, the LLC, and that entity is going to go do what it's going to do. Now, if we got a multi-member LLC with disqualified parties as members of it, we want to make sure we overfund the initial purchase there, because we don't really want to have additional money going in the LLC after that funding. It is possible with some trust companies. And I guess back to the trust companies, we're doing IRA LLCs. It's really important, if you're not working with us, make sure you're working, you understand what the trust company is going to require for the LLC, because some trust companies won't allow you to be the manager of the LLC. Other trust companies will require your tax or legal counsel to sign a document stating they're experts all things IRA, which they probably don't want to sign. And some trust companies will require a third-party review of the LLC's activities annually. So it's really important, don't just pick a trust company out because of cost. You know, if you're working with us, we've got trust companies that we work with day in, day out. We know what they want, they know what we want, and they take care of us. But you know, other than that, you just don't want to pick one out because of cost, because you don't know what they're going to allow and what their level of service is, and they're all going to be different that way. 401k plans, very, very easy. Okay, we're going to move the money from the plan you got or the IRAs that qualify. We're going to move those funds into this new 401k plan. So when you engage us, we're going to create a 401k plan. We're going to give you the federal tax ID number for it. As soon as you've got those things, you're going to go to a bank and open a checking account in the LLC, or not in the LLC, that's a checkbook IRA, in the 401k plan's name and EIN. And then you would direct your current administrator, custodian, wherever those funds are, to fund that account. So they can wire funds in the new plan account or send you a check, whatever it is. It is possible actually to take money once a year out of a retirement account for up to 60 days. And you know, so if time is of the essence and things aren't ready, you could get the money to you and then get the money from you into the account too. But you know, it's critical, obviously you can't have it outside of 60 days. But 401k plans I love, because you can't source them with beneficiary and inherited IRA or Roth funds, but we can have Roth funds in them after you've established it. You've got the max contributions short of a defined benefit plan, no tax on leverage, so no UBIT on leveraged real estate, no custodian, and you can invest literally in anything other than collectibles. And the other thing that you cannot do with an IRA, you can't borrow money from your own IRA. You can borrow from a 401k plan, half what's in it, to a max of $50,000. Biggest thing I think with the 401k plans is if you commit a prohibited transaction with an IRA, you've distributed all funds in that account as of the first day in the year in which the indiscretion occurred. The 401k plan, it's only the money involved with the indiscretion. Huge difference there. So joint ownership, if you want to combine personal and planned money into a common investment, you can do that. And you can do it either tenancy in common, and you'd need a TIC agreement. Tenancy in common agreement specifically spells out all the operation of the property. And by the way, you should have that even if you go buy a property, vacation property with a friend. You should have a TIC property spelling out how things work. If somebody wants to sell, what happens? Because you know, they might want to sell. You and I go buy something. What do you think the odds we're both going to want it? It's going to be in 5 years? Probably not. So, you know, what happens if I decide to sell? Do you want to have some saying who's going to buy, or financing, or the costs that are going to be incurred there? Or what happens if you've got some catastrophic event and we both need to throw money in there? If you don't have the agreements all in place, you could have a problem. So it's just a good idea to have that, but it's got to be an IRA specific limited. Well, just like with a checkbook IRA specific limited liability operating agreement, in this situation, we need an IRA specific tenancy in common agreement spelling out everything. So, you know, what is nice about the tenancy in common structure is that upon a sale in the future, you personally could take your portion and go do a 1031, and the plan's money goes back into the plan. Downside, maybe the lender requires an LLC. I don't know. They're harder to transfer. If you want to do in-kind distributions, the TIC structure is going to require deeds to transfer an asset, where the joint ownership via limited liability company, you just do an assignment of membership interest. So the LLC, if it's got you and your retirement account as its members, you're just in a situation where we want to overfund the LLC so we don't have additional investments into it in the future. we just don't feel that's as conservative. If additional money was needed, if you're 50-50 owner of the LLC along with your retirement account and it needs another $100,000, you need to put 50 in and the retirement account needs to put 50 in. You can't go 75-25 because you're skewing the membership and therefore that's a prohibited transaction. So my best piece of advice if we're looking at an LLC is to overfund the initial purchase. If and the investment in the LLC, if more money's needed, it's got to come in pro rata. Future sales, the LLC could do an exchange, but you know, it's going to be harder if you want to, you know, split, bifurcate your piece versus a retirement account. But what I love about the IRA LLC is to transfer. You want to do in-kind distributions, you can do assignments and membership interest without ever changing a deed. So that is a really nice thing about it. So writing the offer, we talked about, you know, what you can buy, some issues there, and we're about out of time. I got a slide, so I've got to hurry up and get through this. I'm probably going to be 10 minutes over, just warning you. Sorry about that. Anyway, writing an offer. I mentioned earlier about my comment about planning and, you know, plan the dive the plan, right? In this situation, you need to make sure you're ready to go. So if you're a broker, and you've got a client that says, hey, I want to take my retirement account and go buy this property. Your first question is going to be, what kind of account do they? Well, first question is going to be, is the account ready to go? Because if the account's not ready to go, you can't just write the offer between the seller and that person and have that PSA assigned from that person to the retirement account. That would constitute a prohibited transaction. So just simple assignments between disqualified parties constitutes prohibited transaction. Obviously that's catastrophic. So if they've got an IRA LLC, then it's a simple thing. You know, one, is the account established? Two, if it's established, what kind of account is it? If it's a basic account, you're writing the offer between the seller and the trust company for benefit of that taxpayer. You can't, once again, sign it between the seller and that taxpayer and not the retirement account. It takes time to put it together. So get it together. Do they have an account? If so, what do they have? It's a basic account. Know that you're not writing it between them and the seller. It's got to be between the trust company and the seller. Who's got the power of the pen for the trust company? Where's the earnest money going to come from? You can see where that gets complicated. So if somebody says, hey, I've got a basic account, you're probably going to run for the hills if you know what's good for you. If they've got an IRA LLC or 401k plan, it's a simple thing. You're just going to write the offer between the seller and, if it's checkbook IRA, the IRA LLC, or between the seller and the 401k plan if it's a solo 401k. Simple deal. They need earnest money, you write them the earnest money. During the management, during the ownership period, that IRA LLC owns the property, or the trust company owns the property, or your solo 401k owns that property. So if there's any expense on that property, it's not you, it's the retirement accounts. Any income is the retirement accounts, not yours. You're not personally going to get any benefit short of taking a distribution out of the account. So just keep that in mind always. When you go to sell the property, once again, if you're the broker, something keep in mind if you're a broker in one of these transactions, if you sell an investor a property, if you sell their retirement account a property, they need annually, they need a valuation of the property, all right? So I would encourage you to maintain contact with them. I think if you're the investor and you like the brokers you've been working with, you ought to maintain contact with them. You're going to ask them for a CMA, comparative market analysis, annually, or broker's opinion of value, and that's going to be required by the trust company, or on a 401k plan, it's going to be required for a $5,500 if you've got more than $250,000 in the account. So they need to have that thing. If you're the broker, that's a way to maintain that relationship with your taxpayer. When the property goes full cycle, they're going to probably come to you to sell the property. So it's good for the taxpayer because they got a relationship. They're providing valuations annually. And if you're the broker involved, when it goes full cycle, hopefully they're going to engage you if you've taken care of them. So really take care of, maintain those relationships because it's mutually beneficial. Contingencies to consider in that purchase sale agreement. It's basic account, understand, who's got the power of, signing, the power of the pen there. If financing is going to be there, it's got to be. So I know purchase sale agreements typically have a finance contingency on there, but it doesn't say anything about an IRA specific or 401k specific non-recourse. So I'd put something in there. If you're going to get a loan, this purchase is subject to your ability to get a non-recourse IRA 401k compliant loan. Totally different thing. You're not going to go walk into Wells Fargo Bank, not picking on Wells Fargo. You're not going to get a non-recourse loan there. It's going to be a portfolio lender. Sometimes regional banks will do it, but take a look at myiralender.com or iralending.com. There's a couple of sources there. 3, establishing accounts takes a couple of weeks, so make sure you're ready to go before you go find what you want. I lied to you. I don't have a non-recourse page. So when we're talking non-recourse loans, I just mentioned those 2 sources. Non-recourse, and it can't have the bad boy carve-outs. Okay, so typically on commercial loans, they're going to say, well, they're non-recourse loans, but they've got carve-outs in there for this, that, the other. A truly non-recourse loan, the lender has no ability to go after you. It's not your property. It's your retirement accounts, period. Okay, so the loan's not going to be subject to your credit, your income. It's not going to be attributable to you, nor can they get their teeth into you in a default. So typically you're going to look at a lower loan to value, 50–60% loan to value. You're going to look at a little more expensive money, and those lenders typically are going to want you and a borrower to have some real estate background before they're going to make a loan, because they can't go after you. So like I said, it's going to be something very unique loan, and it's going to be from unique sources, and you're not going to be able to get it from a typical bank. It's got to be a specific portfolio lender or somebody that really understands this space. A few examples and we're done. Okay, so these are all examples of transactions we've done. And this is one that happened actually a long time ago. The last crash, we had a situation where this was actually in Bend, Oregon, and Bend's a beautiful place, but it's sort of boom or bust at times, right? And so in those wonderful areas, sometimes you got greater highs and lower lows. And in this situation, there were some very high-end developments that had been put in gear, developed just pre-crash. And this builder developer there saw an opportunity literally to buy dirt cheap. The issue was, well, how long is it going to take for those things to actually make sense to build on? And he had gotten to a point where he had a nice chunk of capital in his retirement account and didn't want to pay the banks just to have loans on this dirt for an indefinite period of time. And so he thought, hey, this is a great way. It's a great investment for my retirement account, and I'm going to have access to build on it later. You say, well, David, how can he build on property that's owned by the retirement account? Isn't that a prohibited transaction? Yes, that would be. So what happens is we created a checkbook IRA for him. He went out and bought the lots. And then as he was ready to develop those lots would be sold to another limited liability company. And that second limited liability company, he was just a 1/6 owner of. And as those transactions happened, since he was a 1/6, that entity that was doing development work was no longer a disqualified party, and that transaction was allowed to happen. So once again, what we did is we created an entity, the land bank entity, that would hold that land. And then he's got another entity that he's 1/6 owner of that's actually the builder developer of it, and the land bank would sell to the builder developer, so that the retirement account got that nice guaranteed, pop what they were doing, and they weren't involved with business of development or anything, and the other entity was able to go build at will when it made sense. So this is a gentleman that came in, and I had somebody actually reach out to me yesterday wanting to do hard money stuff, and hey, David, can my 401k plan do this? Yes, your 401k plan can make loans, buy notes, do all this stuff. But this gentleman came into us, and his initial question, he was a real estate guy, doctor that had institutional medical practice, done very well in his life, lots of doors, tired of the terrible T's, toilets, trash, tenants, turnover, which is ironic. He came to us because he was considering buying a mobile home RV park, and then he, I think, realized, gee, I don't need the terrible T's again. So he ended up shifting gears, asked if he could buy a note, and this, these numbers, if you're looking at them, go, God, when was this, right? I think this is just an example of, think about section 121 to the universal exclusion, the 250 or 500 exclusion you receive on the sale of primary residence. That was put in place in 1997. It's woefully inadequate today. But in this situation, this wasn't that long ago. I mean, where we had properties, and this was a Palm Desert deal, condo that had been worth $200 to $250 pre-crash, was then selling at $70,000. The mortgage broker was a friend of this guy's, and he says, hey, I've got this note, I'll pay you 11%, 50% LTV. So $35,000 investment getting 11%. And you go, well, that's nothing. Well, that was a lot of times people come to us and they sort of dip their toe in the water. So that's what this guy did. And he decided he didn't want the mobile home RV park, started buying notes. The first one is exhibited right here. And he did a series of, he actually ended up rolling several $1 million into his retirement account, buying paper. The best investment he ever made, I think, was a wind power plant. It was like a wind power plant needed like $1 million. And it was paying him, I think, 19%. It was a first. So he was just sort of cheering him on to default. They didn't, but he ended up, it was a great situation. He had a relationship with these mortgage brokers. People ask me all the time about this stuff. Once again, we don't sell these investments, but you find those investments and talk to us about it. We'll see what we can do to get you into those things. And we do have some sources. People, there's a couple of companies that we work with that actually have funds that buy notes. We've got other people that just sell notes too. But this is something that, once again, diversification gave him what he wanted. This example is a situation where it was last crash. This is a bailout. This was saving a property. This guy came to us and he had a $3 million property with $1.2 million loan on it. And that loan was actually with Washington Mutual. Well, it's WAMU around anymore. And he was having problems with it. If the bank went away, his loan was going to go away. He couldn't afford to lose the property. So he said, well, can I take Dad's IRA to pay off this property? And the answer is, no, you can't just take Dad's, IRA to pay off your property. Is there a way to get it done? And once again, these things are stuff that we want you to, before you ever go forward with, you got to talk to your tax and legal people, make sure everybody's on the same page. So we went through the process, said this is what we would propose doing. And we'll create a new limited liability company. The son contributed to the property, so his dad had $1.8 million in the retirement account. So we ended up self-directing Dad's account into checkbook IRA for Dad, and we created a new limited liability company. Junior contributed the property, received a membership interest attributable to his equity in the property. You need an appraisal on that so nobody can skew numbers there. So he received a membership interest attributable to 1.8 that he had in the thing. And then Dad's IRA put a chunk of money in there too. And now that property is no longer owned by Junior. It was owned by the LLC with Junior and Dad's IRA as its members. So the property was owned by an entity that had the cash to pay the property off. Moving forward, they ended up building the property into a multifamily project and going full cycle in the future. But that's an example of what is possible when you work through stuff. This is a transaction where we've got a number of institutional TIC people that will combine personal and plan money into common investments. And typically, it's not the same people, but in this situation, we had a big apartment complex that went full cycle. And the project that this group was buying was an improvement exchange, and it needed work, a lot of work to be done. And so what we need to do, 1031s, if you're not familiar with them, it's very impatient money. You got 180 days to get a transaction done. So the project wasn't really big enough. Well, it was big enough, but we just didn't have time to get the deal done for everybody. So what happened upon the sale, the tenancy and common owners that needed to do exchanges, we did improvement exchanges for that group. And then the IRA 401k money, we just peeled them out of the transaction. They sat on the sidelines. We went to buy the property. those people, even though they wanted to be party to the transaction, ultimately in the future, we took their retirement money and used it as debt for the group buying that was doing the improvement exchange. So now we had the IRA 401k money as lien holders to the group that owned this property doing the improvement exchange. We got the improvement exchange done, gave it to the taxpayers completing their exchanges. A year downstream, we then created a new limited liability company, and the lien holders contributed their notes and received a membership interest in that LLC. So now we've got the project owned by that LLC that has everybody, all the TIC owners and the qualified money as members. You go forward another couple of years and that property goes full cycle. You drop from a limited liability company back into tenancy in common, and then people are free to go do what they want to do again at the other end of the investment life on this asset. Last example, rollover business startup. And I've given this on probably most every class I do on this stuff just because I love it. We had a retired couple come to us wanting to combine their retirement money, go buy a property. That's what we thought. That's what they told us. I said, okay, we'll do a checkbook IRA for you. We want to go buy the mobile home RV park. We're going to create a checkbook IRA with his and her IRAs as the members, and that LLC is then going to go buy the park and they can manage it. Well, they said, well, gee, we want to be the on-site manager, we want to be compensated for it, and we want to live there. Well, living there is a prohibited transaction. Compensation is going to be a prohibited transaction, so we cannot do a checkbook IRA. Oh, well, are we stuck? No, we're not stuck. We shift gears into that rollover business startup. Instead of using an IRA and an LLC, we're going to use a 401k plan and a C corporation. So we took his and her IRAs, rolled them into the 401k plan. The 401k plan bought into the C corporation. The C corporation bought the park, and the investors got a business, they got an investment, and they got a place to live, all with that one transaction, which is pretty amazing. As I mentioned at the top, rollover business startups are something that is really, like I said, it could be an olive branch to somebody's future. You lost your job, you dreamed of owning a business. This is your opportunity. You can go do that. We require you to put personally money into the LLC, invest personally in the LLC as well. But if you want more information on this, don't hesitate to reach out. Plan ahead. It takes 2 to 4 weeks to establish your retirement account. Purchase all types of property with an IRA, SEP, IRA, Roth, or 401k. You can purchase with family members, friends. Cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage. Negotiate from the deal's inception, the IRA or IRLC's name. Don't overextend. Plan on keeping a nice cushion of reserves there. And finally, real estate is a real investment. If you've got questions on this stuff, we've got, whether it's IRAs or 1031s, if you got 1031 questions, take a look at the websites, obviously, or go to YouTube. Our YouTube channel on 1031's got a couple hundred videos on there. It's got videos on everything from cost segregation to selling life insurance contracts to oil and gas investments, all kinds of different things. We do that because we want investors to be armed with good information. Our IRA site's the same way. Just go on to YouTube, type in IRA Advantage, self-directed IRAs, or type in for 1031's Equity Advantage 1031's on YouTube, and you're going to find that information. And I always jokingly say that, if you're having a hard time falling asleep some night, just take a look and it'll put you right to bed. But thank you for your attendance today. If you need CE, reach out to Seymour at IRAadvantage.net. And thank you so much for taking the time with us. Look forward to hearing from you soon. David Moore, bye-bye.